As one of the hottest terms in 2019, crypto loans have been getting a lot of hype recently, especially here in Asia. With the growing demand and spike in interest, let's try to put everything into perspective here and discuss how it's being used, how best to utilize it, and the pros and cons of this lending facility. Please welcome your moderator, DARIUS, and panelists Suju, Rong Lin, and unfortunately, Yama has been unable to make it, so Yulong Liu will be taking Yama's place. Please put your hands together for your panel.
Hi everyone, welcome to the Crypto Loans Borrowing Lending panel. My name is Darius and I'm going to be your moderator for today. I'm wearing glasses because of surgery, so not being a douchebag here. I'll allow the panelists that we have here to make the introductions. I know we've assembled a very good panel for you guys here today. Just a quick introduction of myself. I'm the managing partner of QCP Capital. We are a trading desk run out of Singapore, and we focus on the region. I'm the moderator here today because we are mostly borrowers and not lenders, so the guys on the panel do both. I'll let them introduce themselves.
Hi, everybody. My name is YULONG. I came from a very traditional financial background. I was an investment banker at Lazard and doing private equity before I joined a crypto fund. So now my current role is trying to help a firm called BabelFinance to build a global partnership. At Babel, we are a major lender located in China, serving primarily the miners as well as more increasingly to the hedge funds globally who trades crypto.
Thank you. So hi everyone. This is Rong Lin, and I'm vice president and founding partner for Matrixport, which was previously part of Bitman, and right now running trading, lending, payment, as well as custody services. Myself was also from a traditional finance background. I was working with Deutsche Bank for their structured derivative desk for several years before I joined Ant Financials.
Hi guys, my name is Suju, and I co-founded a hedge fund based in Singapore here called 3 Arrows Capital. We trade primarily in the foreign exchange markets as a market maker, and we trade crypto now as well, both borrowing and lending, as well as doing mostly market neutral arbitrage strategies.
Great, thanks guys. Maybe we can start with an introductory question for Yulong. Babel has grown a loan book very quickly in a very short time, and quite a big loan book. So just for the audience, what is your typical client, a borrower, the borrower lender? Like who are they, and what do they use the loans for? Yeah.
Sure. So a little bit history on Babel. So we were a fund set up last year, and we were funded by some domestic VCs. Now we are gradually being supported by major funds, including a subsidiary of banks, trying to build what we call ourselves a crypto-native bank. So essentially, the business we offer, we take crypto as a collateral and give out stable coins as loans to the borrowers, or vice versa. And then currently we have about over $330 million worth of loan outstanding, and primarily serving the miners in Asia. When you talk about crypto loans, as of now, there are primarily two use cases. Number one is the miners, when they try to mine, they want to be the holder of BTC, and then while they have to cover their operating expenses, that's where we came in to take those BTC, the mine, as collateral, and give a competitive rates for them to pay off whatever operating expenses that they have. The other portion will be someone like Zoo or Darius, where they are active traders on markets. Whenever they see alpha trade opportunities, they may want to keep their beta exposure, the inventory on the hand, and while have some additional liquidities to capture the alpha tactical trade, then we came in to take those inventories and then give them the bullish, being BTC or being stable coins for them to execute the tactical trades. So globally, there are a few key players. And then at Bubble, we are also, I think we are the first one to try to connect these silos of liquidities in the US, in Europe, try to connect this inter-platform loan system where we borrow against each other, very mimic the interbank loan markets. We try to make the interest rate as balanced as possible across the board, or it could be considered as an interest arbitrage globally. So we try to bring those gaps from the east to the west. Thank you, Darius.
Thanks, Yulong. Well, a question for Ronglin. You know, at Matrixport, you guys do many lines of businesses,
Yeah.
and borrowing lending being only one of many. How does the borrowing lending desk, you know, interact with the other businesses and interact with the other desks?
Yeah, yes, you're right. Actually, before Matrixport was even founded, the whole team has been building up all those functions, trading, lending, payment custody for internal client, that is Bitman itself. So lending business really benefit from the fact that there is this other services available. So save us a lot of efforts. Say for collateralized lending, one very important part is the custodies of the collateral. So we have developed like bank-grade custody solution already. And then the other very major components is trading. In the events of a very dramatic drops of BTC and other cryptocurrencies, you've got to want to have a very good liquidity. So all of our risk management systems are well developed, and then we connect API with our internal trading desks. So in the events of very severe market situations, all the liquidation could be done within milliseconds. So this does give us lots of benefit. I mean, the other way around, the whole company benefit from the fact that there is a lending services. So some client would love to do trading and do leverage, so we could provide funding for their usage. Yeah.
Cool. Thanks. Question for Sue. You know, Sue has been you've been a successful banker, a fund manager. You know, you made a name for yourself in the traditional finance space. So, you know, just wondering what are the key differences between crypto borrowing lending or crypto rates and traditional borrowing lending and traditional rates?
Sure. I think it's still quite an immature market in crypto, and a lot of the basic services and infrastructure is now being built, I guess, to sort of combine the people with the monetary base, you know, the people who own the Bitcoin and the stable coins with the people who are operating the day-to-day trading of on various venues to tie liquidity sources together, right? So I think, you know, in the traditional markets, just taking FX as an example, you know, the prime brokerage model has been around since the early 90s, pioneered by Deutsche, right? To enable hedge funds to be able to buy and sell restricted currencies and then to trade G10 currencies on leverage. And later on, that became offered to, you know, second tier, third tier, fourth tier banks, as well as to corporates. And so there was a multi-year period over which leverage was introduced in the system. There was more borrowing and lending of collateral. And I think in crypto now, the market's finally it's starting to mature to the point where, you know, that there are now firms that see this as a way to manage risk, to hedge risk, right? Whereas if you look at the previous bull cycle, you know, the 2013 cycle, there was no real way that miners could hedge risk per se. There's no real way that they could sort of manage. So I think that's really interesting to see. And I think from that point of view, we're probably in like the mid 90s of where, you know, PB was for, you know, traditional markets. So.
All right, thanks. I mean, on that note, I mean, a question back to Sue and the other panelists as well, right? And a question that many people ask as well. You guys are all centralized borrowing lending shops. What do you think of DeFi borrowing lending? Is there scalability there? You know, any thoughts around that?
Sure. I think DeFi lending and borrowing is very interesting. I think the Maker project and the amount of DAI that it's been issuing is, I think it's around 120 now, the debt ceiling. So I think that's actually a very good source of dollar liquidity in some cases of the market. Like we would use that, we would post Ether and then borrow DAI against it. Because the rate now is only 5%. It's actually a lower rate than in the centralized markets, right, to borrow dollars. But I do think that it's not an either or. I think both will serve important functions, and there's certain types of loan agreements that will never get done in DeFi. It's just impossible. And then there are some that DeFi is useful for, to have a peer-to-contract ability. It attracts a lot of pools of capital that wouldn't have been able to KYC with a, with a broker. So.
Right. Yeah. I mean, on that note as well, I mean, one of the questions that most people have around borrowing lending is, the back end of the loans. What happens to the collateral? How is it being used? Is there any rehypothecation going on? Maybe you guys can shed some color on that as well.
Sure, I can comment first. I think as of now, the current way of doing lending is over-collateralized loan. So as our goal is trying to be the digital asset bank, crypto-native bank, right? Risk is certainly one of the areas that we very much focus on. That could mean on one hand, we have to offer really competitive proposals to offer in terms of interest rate, in terms of LTV, in terms of flexibility of the terms to the clients. On the other hand, the back end, we have to do essentially duration management will very much resemble what the traditional commercial bank will do. You have to match the supply and use of those capitals. So within our platform, one thing we are very proud of is we guarantee our users we will never use your collateral by giving them a physical address, that we will put the collateral up there as transparent to you guys. You can see there's no movement after the funds being deployed to that collateral. It's going to be there 100% of the time. The other thing that we do offer to client is a lot of times when people taking the collateral, maybe starting with 60 LTV, right? And then if Bitcoin price moves up, and then we actually give back, refund a part of the extra collateral back to the clients. Versus some other institutions, they actually only ask you to top up your margins of the extra margins they don't have currently they don't have a mechanism to give it back. So the smaller things I think is what make a difference nowadays. It used to be a very early stage industry that there's a lot more low-hanging fruits out there. So everybody offer different kind of product to the markets. Now the competition is getting tighter, and then the product itself is getting a little bit more sophisticated, as well as the end user of the product. So we are essentially entering the stage where we're competing with institutions very much like traditional banks. So we offer customized solutions to different institutions, could be miners, could be hedge funds. So the complexity is kicking into the markets, which in general I think is good for crypto as a whole, as there are more and more choices, instruments, which enables everybody's needs to be fulfilled.
Yeah, I mean, for us, we respect a lot on the whole banking system as well. And we understand that there are typically two ways of using the collateral. One is to sit there. And the other, I think that some of the lenders in the market also use the collaterals to do some investments or tradings or other activities. But for us, Matrixport, we adopt a more conservative and safe approach. So yeah, we never use the client's collaterals to lend out or to do investments, etc. So we put it in our custody solutions. So it's well developed. And for all those collaterals, we do have an active management systems of risk. We have the whole back end of the risk monitoring systems, and to see how much portion should be put into a very hot wallet if it is approaching the liquidation lines, and then how much should be put into a more safer sort of like a cold storage. Yeah.
Yeah.
Sure, and then for us, I guess it's a bit of a different perspective as usually a net borrower of collateral, and the deals that we would do range from sort of uncollateralized, where we're just taking the capital and not giving anything, to over collateralized. And the way I explain it is, it is a function of the rate, right? If the rate is, if someone wants very over collateralized, then they'll probably have to they'll get a very low rate, basically. And if they are willing to do uncollateralized, they can get a higher rate. So it's all a risk spectrum, it's all a credit spectrum. And we're one of the most active borrowers from the desk, like Genesis or blockchain.com, some of these big lenders off their own balance sheet. And I think there's a risk curve for sure there where if they get comfortable around the activities that the firms are doing in terms of market making, doing arbitrage, trading the basis, I think that's where a lot of the origination happens still. But I do think like what these guys are doing as well, it's definitely becoming a bigger and bigger part of the market where it's being used as well for as an end user and actually needing that fiat to pay out. So.
I do want to touch on that. I was talking to Carl, one of the colleagues of Sue back then, 2 days ago. Essentially, I was trying to ask him, how can we, as a lending service provider, how can we best serve your interest as a arbitrage firm, right? So what their request is basically simple. Other than interest, they want to have a super lean LTV value. I understand from their point, they want to be capital effective. And then from us, we want to be risk controlled. So one of the ways I think this could be a workaround is we all use very much like a prime brokerage business model in hedge funds, where we all use the same custody, right? All the funds stay within that platform, and then even though we don't have direct access to their assets, but a third party could have that access, and then we can give them loan with the lower LTVs to help them to fulfill whatever trading needs that they have. But I think we are not there yet, right? But we see the emerge of 3 guys, custody service providers, trading platforms, as well as lending platforms. They are merged together to offer complex, full suits financial services to trading, sophisticated trading institutions nowadays. Less so on the miner side. Miners sort of, they have different needs. But for the trading guys, I think you may or may not, we are moving towards that direction.
No, I fully agree. I mean, a prime service would benefit not just borrowing lending, but all aspects of the space, derivatives, spot, and so on and so forth. And on that note, I mean, you guys take prudent risk measures, but at the same time, like you guys mentioned, that there is no centralized authority, there is no prime service in the space, and there are a lot of concerns with guys who don't take as prudent risk measures as you guys do, or don't handle collateral as responsibly. How does that affect your business, and how do you compete with these guys, and what do you see as the future for regulation in the space?
One of my concerns has been, like funds that when they borrow, it's not clear if they're borrowing to do arbitrage or to take directional views or to do any number of things. And I've seen this strategy mix from some types of borrowers in the market, and that it's always been something that concerns me a lot, because I think that in the traditional space, right, where if you were to go get a credit line from a prime broker, right, they will do a very long due diligence on exactly what you're doing, your track record, your audit, your administrator, all these things. And usually they even need a couple years before they'll even onboard you. So like prime brokerage onboarding is very difficult actually in FX, right? You need a very long track record. There's probably only, each investment bank only has 30 to 40 clients that they will be willing to extend this kind of credit to. And that's even with having all their collateral there and having all those give up trades come into their book. It's still a very sort of a vetted experience. Whereas my fear in the sort of decentralized lending markets has always been that a bad actor can come and borrow for other reasons and be willing to pay a higher rate or be willing to do a lot of things that don't make a lot of sense, like economically, and sort of as a result, kind of taints the whole market in a way. So that's always been my big concern in this market. So.
Yeah, I definitely think, I mean, on that, mentioning that, I think education in terms of the rate space is a little lacking. And sometimes it's hard to differentiate the bad actors from the good actors. I mean,
Yeah.
how do you guys handle the education part, and how do you deal with that?
You mean the risk management part?
Yeah, so educating your clients as to what exactly you guys are doing, and how bad actors function like compared to you guys.
Yeah, sure. I mean, I would say that so far the best education comes from the market itself and the client experiences. For us, because we were connected to our client directly, both from the Matrixport and for their mid-bands ecosystems, what we did is that for every trade that they traded with us, because we're traditional guys, right? So we put together all of the explanations and as well the risk disclosures and everything to the clients to make sure that they understand. And the other thing there is actually how we design our rate systems. So we even told our clients what is the rate out there, say, in the crypto lending space. number one, the collateral safety. So what are the cases out there? And number two, the market rates of your collateral's value. So I think for client, they experience a loss during all those bad days when BTC dropped a loss and they got liquidated with a price that is determined by the exchange itself. And then gradually we see the client pay more attention to this. So we benefit from the fact that such event happen exactly. And then we design the index itself to offer to our client, etc. I think for the risk management parts, right now the market is at a very immature stage. Especially for a borrower, lots of borrowers are miners that are more good at the traditional business, doing minings and building up mining farms and buying equipments, but lack the knowledge of finance. I think it's good that we saw lots of traditional finance professionals coming into the space, and then we hope to make the market better together. Yeah.
Yeah.
I think I just want to add on one point here. So yes, we offer additional products. The current group of users are less sophisticated, but they also want the same kind of protection as the professional traders. That's one add-on value we provide to the platform users of BabelFinance, which is simple. We give them something called insurance. Essentially behind is a put call option combined, right? So we give them a simple concept, and then so that they can protect the volatility of the market without having to know the full details of what essentially is a call and put combined, right? So that's one thing offered to the clients. The second thing, when you were trying to say how do we prevent the bad actors or the evil actors in the space, I think KYC and then at some level of know your customer is what we always practice. Even though as of now there's no clear regulation on how financial institutions like us should regulate ourselves. But it's a profitable as well as a highly, potentially risky business. You have to manage the both sides, the duration very well. So we manage that in two tranches. On institutional side, we do little bit more analysis on the trading strategy. What do they do with the money we give it out to them? So then we factor those into the LTV values that we have. Right, and then for the smaller clients, we can simply give them a smaller credit limits, and also everybody here is fully characterized. It's really the value of LTV. That's where we're adjusted. On one side, we want to keep them as prudent as possible. On the other side, we want to offer the best service level in terms of business, making business sense to the customers without jeopardizing their capital efficiency. So categorize them into clienteles, playing around with the LTVs, and gradually we have a large number of data based on our previous track record. We can do a little bit credit score based on whatever the client behavior is, and then we're not there yet, but I think that's one of the angles everybody is getting into, very much mimic what happens to the traditional digital finance industry. All right, so I think that's what will happen.
Great. Yeah, I think this is extremely valuable information for everybody. The rates market is usually the heart of any market, and it bears a lot of systemic risk. It's important for everyone to know what's going on behind the scenes, and what kind of risk measures are being taken. Maybe on a closing note, what's going to be the focus for you guys in 2020, and what do you see as the future of the rate space in crypto?
Sure, I guess. The market this year has turned bullish, so there's a lot of interesting opportunities to try to borrow stable coins or dollars from people. And that's kind of a change from late last year where there was a lot more demand from firms like us to borrow BTC or ETH. And as it turns out, there's systemically less dollars in the system as there is BTC, just because of the fact that BTC is held as an investment, whereas dollars are often being used to invest. So I think both for us, we're doing some initiatives there, and I think for anyone that has an ability to build a business where you're able to sort of take on dollar deposits and give people a yield on that, you can kind of do a lot of interesting trades based on that right now. There's a structural lack of dollars always now in the system, even when we've had big moves down and then derivatives get liquidated, and it always seems that there's active buyers of of sort of longer dated derivatives, and there's active interest in trying to put BTC collateral to work. So I think that the dollar side is really interesting now going forward. So.
Thanks.
For us, Matrixport, I think that the agenda for next year would be, majorly into two parts. Number one, of course, the traditional centralized collateralized lending. We will be launching new products on that. We recently also launched option embedded lending to our clients, and since we have this also very, I think like within Matrixport, there's a very strong finance team with decades and decades of trading experience, as well as the structured derivative knowledge. So we hope to launch some very new products with good protections to the clients. Say there is no liquidation for the clients, and interest rate could be at zero, etc., and to structure and to tweak it into suiting clients' needs. So that is number one. But beyond that, I think Matrixport is a team that have some longer term belief in blockchain. So we have the whole BCH core developers within Matrixport that has been constantly devoted into the blockchain technology itself. And I am myself passionate about decentralized finance itself. So I think one thing that I saw from the current decentralized finance projects that is lacking is really liquidity, because it's like running a platform, and then the essential heart to the platform is your users, your liquidities, and multiple participants in the market. But I haven't seen that in the current project, so that poses a very huge risk. Should BTC jobs, there's not enough liquidity on chain to help the help the borrowers and the lenders for the collateral. So what we would love to take is a different approach. We hope to build the lending business, the trading business, the payment business together to get all our ecosystem clients onto the platform, and gradually we'll hope to try to have a sort of like semi-decentralized way where client could have a very easy user interfaces, very low barrier to interest, and then provided the services by the decentralized way based on blockchains, and see whether we could also advance in that, and also making a small contributions, and together to see the blockchain industry grow. Yeah.
Interesting. Thank you. For us, I think we have three things in mind. Number one, we want to serve our existing customer better. That means primarily miners. So we have provide valuable lending services to miners when the BTC was below 4,000. And then during the same time, there were some natural disasters to the miners, where there were landslides in Sichuan, which hit a lot of the miners. We went in to provide a really attractive loan to them, so that they don't have to sell the BTC to recover whatever operation they have to. They really appreciate for that. So as of now, I think we've seen that come back at a current price level. The miners are not willing to sell, so they are willing to borrow against that. We intend to keep growing that side of business. So number two, we want to provide additional value-added service to the existing group of users. That could mean some kind of insurance product, or could mean a margin trade product. Really depends on what they need. We see that demands coming back to us, fast growing as well. So lastly, we have been very much focused in Asia before. Now, as I recently joined, I want to help bring the same level of services and in terms of interest rate yielding products, or lending and borrowing services to the markets that which they don't really used to have. So that could be in Australia. I'm talking to major banks in Australia, intend to go to Europe, try to sample the markets. It could be that we work for partners locally, or it could be that we actually go out to build a business right there. So we are actively looking for institutions that would like to explore partnership with us to bring the same kind of services we offer to miners worldwide.
Thanks, guys. Well, I think we have some time for some questions from the audience, if there are any.
Hi guys. So in a lot of what you talked about, there's been a lot of talk around risk management, mainly around looking at credit and how you manage that internally. In terms of taking a view and building engines that can help you calculate that more effectively and minimise loss, particularly with large price fluctuation, how are you guys approaching that?
Yeah, I can start first because we spend so much time on building our risk management systems. For us, it's a whole risk management systems, and we even have the back end. And for that, number one is on the market risk monitoring. So we essentially feeding in all the live price from multiple exchanges is a VWAP base, and also we will take out all those unusual pricing source and to get the average of that, and this will be helping us to calculating the collateral value as well as offering the services to our clients. So we keep very closely monitoring our positions on what is the danger lines, what is the liquidation lines, etc. So the whole monitoring, and then set up the automatic alerting systems should there be any abnormal move in the markets. So that is number one, this monitoring. And secondly, it's really on the trading parts. As what I just now explained, we connected to the best liquidities. Actually, QCP is also one of our service providers. So we connected to them both through the API as well as the voice. So for API-wise, we developed an algo that could connect to multiple exchanges and then execute at the best rates in milliseconds. For voice as well as also we have experienced traders to be the backup if there is anything going wrong. And for the liquidation parts, we also developed the different liquidation levels, so as well as different liquidation methods. So we have the controls of the liquidation volume. Should there be a mass job, so we would split our ticket into multiple tickets to make the less move of the markets. And we will also help clients to liquidate and different, it's not whole liquidation, so to protect clients' best interest. And then thirdly, we're employing other services like options to protect the whole portfolio as well as the futures markets instruments. So coming up all together, I think that we have built I would say I pride ourselves as building one of the quite robust risk management systems among all the providers. Yeah.
Great, I think that answers the question. I think we have time for one more question. Well, I guess if there's no questions, we can tie this up. Thank you guys very much for your time and for your answers. And thank you for your time as well, audience. Thank you.
Thank you.
Thank you.